I'm going to talk mostly about the Australian fund this morning because we've got some big things going on. I'll touch a little bit on the international fund at the end, but most of what we're talking about is the Australian fund. And I want to split it up into, I want to talk about the portfolio, some of the opportunities that we're seeing out there today fairly quickly at the start, and then talk about this potential transition to a listed entity. Everything I talk about today, general advice only. We don't have a license to give personal advice. You obviously need to take away what I say and incorporate your own personal circumstances into it. Just a quick update. There's the performance reports are sitting there on the table. You can pick one up on the way out if you want. Hopefully all of you have had a read of it. We've got lots of really positive feedback about that report this year. As you know, we want to provide you with lots of transparency about what we have been doing, but perhaps do that less frequently than other people so we can get on with the job of managing your money. A really quick update from that 30 June point of view. It's been a really good reporting season for us. You would have seen I've been writing in the last few quarterlies that investing can be a really funny game. Sometimes you can be getting a lot of things right and companies are reporting a lot of good news and your investment cases are playing out well and you're not seeing that in share prices, and then other times you can have some things that are going wrong and still the share portfolio has been going up. And I thought December last year and June 2015, some of the companies that we owned were disappointing us in terms of what they were reporting with results. And obviously the performance has still been good, the unit price has been up a lot, but that's not really what we want to see. We want to see companies delivering results, and we know that will translate into returns over time. We just had a much better reporting season, the one that we've been through. I'll talk about a few of the things that have gone right for us there, and the unit price has jumped about 12% so far this year. We also had that last week of June where prices were down a lot, particularly for some of the UK focused stocks that we own that have bounced back early this year. I want to talk about the general environment out there. We've had a really good 5-year period in the fund, and the main reason for that is because there's been lots of volatility. We've seen share prices bouncing around all over the place. We've seen different parts of the market be hot at some times and very cold at others, and people don't want to own things, and then it's all hot again. And that's the perfect environment for value investors like us to get out there and buy things when they're cheap and sell them when they're expensive. What we've seen over the past year is what I would call a levelling of the playing field. So the overall market hasn't really moved a lot over the past 12 months, but I feel like there's less variance amongst the individual opportunities that are out there. We don't have those big pockets of really depressed parts of the market that we had 12 months ago. This is a chart. The yellow line at the top there is basically the overall market, or the large part of the large caps part of the index, and the grey line here is the small caps part of the index. And you can see over the last year, but particularly in the last 6 months, the small and mid cap part of the market has gone nuts, and the large cap stocks haven't really gone anywhere, which you probably know if you own the banks and Telstra and some of those large companies. This has been a huge tailwind for anyone that is invested in the smaller part of the market, and that is us. So there are a lot of fund managers in our space at the moment that are reporting very good results, and comparing those results to the All Ordinaries Index, it's just worth pointing out that we've had a huge tailwind. And that has become self-reinforcing in some ways over the past couple of months. We've got really big listed investment companies like AFIC and Argo now coming out and saying, well, we're not making money in the big blue chip part of the market, so we're going to start investing in more small and medium cap stocks. This, there's an acronym out there called GARP, Growth at a Reasonable Price, as a way of investing. That has become growth at a very expensive price. And I said earlier that I feel like the market has leveled out. The one part of it that I'm really, I wouldn't say concerned because we don't have exposure to it, but the one part of the market that I think people that are invested in it should be worried about is these really high growth stocks. There's some great businesses out there, and the Bellamy's and Blackmores of the world. We saw with TPG Telecom this week and the big sell-off. There's nothing wrong with the business. There was absolutely nothing wrong with the result. That business is still growing, but the expectations that are in some of these growth stocks are sky high. And my experience in the space has been some of those companies will deliver 20% earnings per share growth for a long period of time and justify their price. And you can pay a really high price for a business that's going to grow at 20% a year. That might be 1 in 3. what you tend to get with the other 2 and 3 is that market forces, competition, all sorts of things happen that stop it growing at that sort of high rate for a long period of time. So there's so much money has come into that part of the market over the past 6 months. I think there's some crazy valuations out there, and we're giving it a very wide berth. The other thing that has happened is the mining stocks have gone nuts over the past 6 months. So this is a chart. The grey line here is the materials index, and you can see the first 6 months of this last year down more than 20% in terms of the whole index. It has recovered all of that and more over the past 6 months. You would have seen some of the stocks in our portfolio. Whitehaven Coal that we bought at 38 cents and we sold at 78, closed at $2.50 something yesterday. South 32 was trading in the 90s in January, $2.30 something as of yesterday. That whole space has really got a lot of optimism about it. And I say that I don't think there's the same level of optimism coming into that space. There are certainly fund managers now that are looking at it and saying, well, I don't own any and now I might need to own some. But for us, this was a real pocket of depressed sentiment in the ASX. So when we looked across the market, okay, the overall market wasn't screamingly cheap, but you had these mining and mining services stocks that we thought were trading at crazily low prices. That has leveled out as well. So when I look across the market today, 12 months ago, we sent an email out to investors in this fund saying there's lots of crazy opportunities out there. I look across the market today, it is more of a normal environment, I would say, and I'm not seeing those widespread pockets of, well, those areas of the market that absolutely nobody wants to own at the moment. We're quite happy with the portfolio that we've put together, and I feel like the general environment out there is still quite skittish. There are a lot of people investing in shares because they're worried about the return on cash and they want to invest in the closest thing to cash that they can, and they want to own a business that's got a great growth story, and the second that story is not there, the stock's getting thrown out and people don't really care what price it is. So there's still lots of variance in performance out there, and that is good for us. You know, we've been having a good look at Wellard, which listed just before Christmas at $1.40 a share and is now trading in the 20s thanks to a few profit downgrades. So the more of that sort of, I guess, extreme stock market behaviour, the better for us. I just want to talk through 4 of our favourite ideas in the portfolio at the moment. We've actually got a really nice spread of stocks at the moment that are in different sectors and have different risks and uncorrelated risks with each other. We've picked 4 here, but we've probably got 10 that we could have put up that I would say are, you know, equally attractive. Like I already touched on, I don't think there's anything in the portfolio that's trading at 10% of what we think it's worth, but we've got lots of those middle of the road ideas, and you'll see them in the portfolio at 4, 5, 6% portfolio weightings, and that's where most of the performance has been coming from, is that middle of the portfolio. I'll start with Macmahon. We've owned it for a few years. It won't be a new idea for a lot of people, but it is in a very different place than it was a couple of years ago, and the risk profile has changed a lot. I probably could have put it on the list of disappointments from reporting season. We had a mostly good reporting season, but a few disappointments out there. Macmahon was probably one of the disappointments, and I say that because it has come through a very, very difficult period. They got their business from a lot of net debt to a position of net cash. They've got a few contracts that run for the next 5 years, and we really thought 2017 was going to be the year where this business started generating profits and paying that out to shareholders. And then they won a contract, and in the mining services space, sometimes winning a contract's the worst thing that you can have happen to you. They're going to lose $20 million on this one contract that they've won at Telfer, and they're now saying, okay, that's going to hurt our profit for the second half of last year and the first half of this year. So it's now 2018 until we're going to see profit. But look, there's $350 million of revenue there in that business that it's pretty much locked in for the next 5 years without them winning a new contract at all. We think they can generate some decent margins on that. We think there can be some growth, particularly at the Tropicana mine where there's talk of some big expansion there, and it should generate $20 million a year of EBIT. Now it's 145 market cap, there's 60 of net cash there, so you're paying $85 million for a business that we think will do 20 million or so of earnings. It's mining services, so I would never say it's safe, but this business has more visibility about its workbook there than most. Jumbo Interactive, it's another stock that we've owned for a while, and another one where the story is a bit different today from what it was even a year ago, I would say. We've owned this company for quite a while, and we bought a lot more of it at the 90 cent range last year, and we've become a fairly substantial shareholder. I think we own about 13% of the outstanding shares in Jumbo. And they have a very, very good business here in Australia, selling online lottery tickets. So Powerball, all of the lotteries that Tats offers, these guys have a database of customers that they sell lottery tickets to through mobile phones and their website. That business has been growing for quite a long time. It throws off a lot of cash flow. It's a really nice business. But the company has been trying to expand out of Australia and overseas. They've tried to build a business in Mexico, in the US, and one in Germany that has been losing a lot of money for quite a long time. The management of the business, so there's the guy who runs it owns about 20% of the shares. He's got a lot of skin in the game. He got a bit caught up in the whole growth story though, and he had a few very growth-focused brokers that were pushing him to do this overseas expansion and really selling that story. And he had a lot of shareholders that expected it as well. We went up and saw them October last year, and I just did a little presentation to him. I said, look, your share price is trading at 90 cents. I think it's probably worth $3 a share, and you only need to do these really simple things to get there. A, stop losing money overseas. B, increase your payout ratio. You know, this business throws off a lot of free cash flow, and they're paying out about 20% of it a year as dividends. 3, return some of that excess cash that you've got sitting on your balance sheet to shareholders. And 4, stop promising the world. The biggest thing for me, under promise, over deliver. They've got a growing business. All they needed to do was show that to people. We've made some progress on that front. If you go and pick up the latest annual result, you'll see the dividend is up a long way, which is really good. They're sending some very strong signals that they're going to either shut down or sell the business in Germany. We're hoping that's by the end of this year, but at worst, I would say by the end of the financial year, that business will be gone. And they've shown a lot of growth in their Australian business. You know, it grew from 8 million of EBIT last year to 12 million of EBIT this year, and you're not paying a very big price for that business. So we've got a little bit of success there, I think, just sitting down with that company. And a lot of these guys don't have a lot of experience with the stock market. So they bring a company to the market, they're a CEO, they're not really sure what to do and how to conduct themselves. And for us, it's been a really good experience just in the value we can get out of sitting down with some of these guys and saying, okay, here is the value of your business, here's what the market is going to appreciate, and here's what you need to deliver to show it. We think we've got a fair way to go there. It's still a 70 million market cap at the moment. They've got free net cash, so their own net cash of 17 million, and this growing Australian online business that's doing 12 million of EBIT a year. So it's still a very attractive price if they can show that those earnings are sustainable. I'll come to CardKnow in a second. Reckon we've written a lot about in the last quarterly report, so you may well be familiar with it. It's an accounting software provider. This is a turnaround story, and those of you who've been invested with us for a long time will know we're typically early with these types of things in terms of we're prepared to hold them as they go through the turnaround. You'll see a lot of people out there saying, I want to see evidence that this is working before I'll buy it. We're quite happy to own it early, and this is an example of a stock where the turnaround is early. They were distributing Intuit, which is a US company's QuickBooks program in Australia. They've got a lot of customers that are using that program. And Intuit wasn't building a product for the cloud, so a product that you could just access over the internet, and Reckon wanted to do that. So they had this big bust up with Intuit, and they've built their own product. And it was about 2.5 years ago that process started, and we think they're making some pretty solid progress on it. But look, our investment case is that they've got this practice management business, which is the software that large accounting firms use to manage all of their clients. So you send them your file, they upload it into their system, do all of their work, send it back out. The core system that does that for an accounting business, they are providing that software for 4 of the top 5 accountants in Australia. They've got, I think the number's something like 80 out of the top 100. They are a very dominant provider. And we think, look, it's not worth the whole market cap, but it underwrites a fair amount of the current valuation of the business. So We think there's limited downside because of that, and you've got this retail business which they have one very big advantage in. So Xero has an absolutely wonderful product, MYOB has an okay product and a lot of established clients, Reckon has a very new product and a lot of established clients. The key question is whether they can convert a lot of those of their existing clients across to their new product. I think it's a huge asset. You know, Xero's out there paying $400 or $500 to attract a customer. They already have a bunch of customers that are using their software that they just need to turn up to and say, why don't you shift across to this? We will see. We want to see them deliver on it, but we think there's a lot of upside and limited downside. And then one we haven't spoken about, I wanted to give everyone a bit of new news, I guess, that comes along to the seminars. You'll remember coffee from the past few years. It was an important contributor to the Australian fund portfolio. We've invested in a company called CardKnow, which is a similar type of business. It's an engineering services business. It's a roll-up that went horrendously wrong. The share price of this business was $6 or $7 a few years ago. They took on too much debt. They, like all of these roll-ups, bought a bunch of businesses that didn't deliver the earnings that they expected, and it fell a long way. Private equity company has come onto the register. They've done 2 capital raisings, paid off a lot of debt. They sold a business earlier this week that we think will leave them pretty close to debt-free. So the debt issues are behind them and they have a lot of revenue. And when we're investing in these turnaround type of stories, I like revenue because margins are a much easier problem to fix than revenue problems. If you're out there, you've got a shrinking business and you're trying to find new sources of growth, management teams can often do stupid things. I think it's really hard to do to replace falling revenue. If you've got a lot of revenue, but you've got too much cost in your business, it's a lot easier problem to fix. We're sort of riding on the coattails of private equity here. They now own 40% of the stock. They've got a very strong vested interest in getting the right management team, the right cost structure in place, and we're backing them to deliver on that. We first started investing in it at less than 60, and unfortunately the share price has run up quite a long way. We think we were probably about half value at that 60-cent level. So it's another example, I think, of one of these businesses that has been thrown out by the market. We think it's got some reasonable prospects and is a big turnaround candidate over the next year or so. Okay, so that's where we sit with the current portfolio. We are sitting on a lot of cash at the moment. The cash weighting's about 25%. And that comes back to what I was touching on earlier, that we're not finding the widespread opportunities that we were finding a year ago. I think it's reasonably promising that the market is still as skittish as it is. So as we've seen over the past year, it's very easy for us to find new opportunities. But we're sitting on plenty of cash at the moment, and we will keep doing that until we find opportunities to put that cash to work. Okay, I want to talk a little bit about where we've come from before I talk about where we're going to. We're 7 years into the journey now as a fund manager. I think some of you in this room were here when Kate and I first came around and did our roadshow. We were down in Wollongong yesterday, and we actually haven't been back since we did that first roadshow, and someone said to me down there, you only turn up when you need something from us. But it's not true, I promise. It feels like a very long time, actually. It's been 7 years in the making, and look, 2 years in, I think the return was still negative from the fund, and we were still less than $20 million of funds under management, and as a business, burning a lot of cash and not paying anyone very much in the way of salaries. And the past 5 years have really been good for us and very, very good for those people who backed us early on as well. You can see that since inception return there now is 14.7%. Someone who invested $100,000 with us 7 years ago is now sitting on about $260,000, and all of our clients are people like you sitting in this room who are trying to save for their retirement, and we're making a real difference to those people, and I'm really proud of what we've achieved over the past 7 years.